global investment transactions have been broadly flat compared to last year, but the composition of those flows has certainly shown signs of change. The biggest, most notable change of those is the fact that some economies that have been very active in the past, like the petro economies, such as Norway, Qatar, the UAE, have been particularly quiet. And that is broadly tied to changes in big picture macroeconomic stories, like the slowdown in the commodity supercycle more than anything. The U.S. is still very active in terms of as an exporter of capital, and in terms of its impact. If we take the City of London, for example, cross-border investors tend to bid yields some 70 bips lower than their domestic counterparts would, whereas in Paris CBD that spread is closer to 110 basis points. So that in itself gives an indication of the direction of travel. If those flows were to cease, we are fairly confident that those yields would be much higher. In terms of what other broad sector trends we've observed or risks around capital flows, the spectre of rising interest rates is something that investors might be worried about. But in reality, given that the macroeconomic outlook is still fairly healthy in terms of there being no imminent recession risk in the largest, most developed economies, we seem to think that the pass-through of rising interest rates to property yields should be limited and gradual, just like the increase in government bond yields across the world.